welcome back to our last in our series of estate planning tips with Carl and Mike. Today we're going to talk about something near and dear to your heart about charitable giving and how to make the pie bigger when it's actually not that big, but you can actually make it bigger. And Mike's going to share with you some stories and techniques to do that.
Well, Carl, when we talk about charitable giving, so many clients will say to me, Mike, I make regular charitable gifts to my place of worship, to my university, to those organizations that I feel strongly about. But when I die, I want to make sure just my children or my grandchildren get my assets, and I don't really have room to make charitable gifts at death. Well, one of the things that we work with many clients on is how, as Carl said, to make that pie bigger so you can include charity, not at the sacrifice of your children. Now, I'll give just a quick example of a client who sold a business. When he sold his business, he got stock from a publicly traded company. So a publicly traded company bought his tool and die shop, gave him the stock in this publicly traded company as his purchase price, got a great price, he was very happy. The problem was, in retirement, when he wanted to do something, to travel, to buy something, what did he have to do?
Sell stock.
And when he sold his stock, what did he have to do?
Pay taxes.
Right, and that was driving him crazy. So when he came in to see us, we talked to him about, well, would you be interested in maybe utilizing charitable giving to reduce your tax burden? And his first objection was, I give enough to charity already. I'm at my limit. I don't need to make any more charitable gifts.
And I don't want to pay any more taxes.
And I don't want to pay any more taxes. But what we explained to him is we utilize in this case something called a charitable remainder trust. But there's a lot of techniques that can be used. But in this case, we talked to him about setting up this trust and putting some of his stock from this publicly traded company into the trust. Once he did that, he got a charitable deduction for creating and funding this trust. So he reduced his income tax right off the bat. Number two, the trust was allowed to sell the stock without paying capital gains taxes. So he got a charitable income tax. He was able to sell the stock. Once it was sold, he was able to also diversify that stock within the trust, so he wasn't all in one stock. He and his wife got a distribution from this trust for the rest of their lives.
Nice.
All right. So he's getting a distribution. The stock, by the way, wasn't really paying a dividend. So he was getting no distributions from the stock. He was forced to sell to get income. Now he was getting an income from the trust, saved income tax, saved capital gains tax, and when he died, this trust was designed to leave money to charity, and so it reduced his federal estate tax. So he saved estate tax, capital gains tax, and income tax. Great plan. In fact, he was so excited about this when he understood how it worked. He wanted to bring his kids in and say, I want you to explain this to them. And we did. We said they're going to get this charitable deduction for setting it up. They're going to avoid capital gains tax when they sell the stock inside the trust. They're going to get an income for the rest of their lives. And at death, they're going to get a charitable deduction for a donation to charity, which is going to offset some estate tax that they had to worry about. Kids were great all the way up to that part about at mom and dad's death, the money in the trust was going to charity instead of to them. So we solved that problem as well, though. We had mom and dad buy some life insurance, and we bought a type of life insurance that's on both mom and dad, so it's called second to die. It doesn't pay anything until they both die, but this life insurance was then paid to the kids. So mom and dad used some of that extra income now they were getting from the trust to pay the premiums on the insurance. And they got the income tax deduction, they got the income they needed, they avoided capital gains tax, they avoided estate tax, and when mom and dad died, guess what? The insurance policy was paid to the kids. And that more than replaced what was inside the trust, which ended up going to charity.
Wow.
So charity wins, the kids win, mom and dad win. Who doesn't win?
Uncle Sam.
Uncle Sam. And nobody was crying any tears about that. So, again, an example of making the pie bigger by including charity in your planning.
Hey, that's a great idea, folks. So try to remember that. Give us a call if you'd like some more good ideas, and join us for some of our future presentations on tips in estate planning and investing. Thank you for tuning in. Hope you have a great day.